Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker, Episode 3. Today we have Daniel Snover. He is the founder of PMV Capital, as well as the portfolio manager of the ARP ETF, which stands for Adaptive Risk Parity. If you don't know what risk parity is, today you're going to get a lesson on it. If you don't have it in your portfolio, you're going to get reasons why you absolutely should. I think Daniel and his team do a wonderful job with the systematic approach they take towards risk parity. So I hope you enjoy this episode with Daniel Snover. Hey, Daniel, welcome to Behind the Ticker. Thanks for joining the show.
Nice to see you, Brett. Thanks for having me on.
So before we get started, we're going to talk about your adaptive risk parity ETF today. We're going to talk about your firm, but why don't you tell the people a little bit about who you are, your background, and how you got to where you are today.
Yeah, sure. So I started in portfolio management and asset allocation right during the financial crisis in the 2009 period. So I think, a lot of people's early experiences kind of determine their outlook on investing and how they think about things. And that's certainly true for me. So, I've always been concerned with figuring out, how we kind of manage this market risk, systematic risk. And my approach to that has been through asset allocation and, mixing in stocks, bonds, commodities in a way that, really manages that risk. And so that's what we're doing at PMV, and that's kind of the origin of my story.
So at PMV, we'll talk about the ETF, but what else do you get? Do you guys do anything else for clients? Do you do sub-advisory work or anything else at the firm?
We do. We have some separate accounts that we manage, but our primary focus is really on the ETF. And but we have a series of risk-based allocation models that are in this risk parity style. And we'll use our ETF as the active component, and then we'll mix in, other static positions to kind of get people to where they need to be. But we have a series of those SMA portfolios.
Yeah, that's great. So I guess I'm curious too. What made you really start the firm? I mean, you started your career, like you said, in 2008. But what made you take that entrepreneurial leap and say, I'm gonna go out and do this myself?
Yeah. So the firm I was working with out of school, I became an owner in and actually sold that business in 2019. And I worked with a firm that bought us for about 9 months and wasn't really doing the portfolio management side that I wanted. And so I thought, I need to go off and do my own thing. And so the two partners I founded PMV with, I had worked on in a previous capacity for about 10 years. So they were good friends of mine. And so I brought them the idea of starting our own thing. And so in 2020, the firm actually founded, and then we kind of quickly realized that the industry was moving, towards we needed an ETF to really get our strategy out. Advisors don't really want to pay 30, 40 basis points for an SMA. And even our current SMAs we offer without additional charge to the advisors because we mix in our ETF product. So I think really to compete, and given the active nature of the strategy with the tax consequences, we needed the ETF structure. So we spent all last year getting that set up, and our goal was to have it launched before year end, and the ETF was launched in December.
Yeah. So we launched at about the same time. So
yeah, great.
we're fairly new to the whole space, but so you manage, like you said, the ARP ETF, which is the Adaptive Risk Parity ETF, but what does risk parity what is it designed to achieve? What is the goal of risk parity from a high kind of theoretical level?
Yeah, the highest level, the goal is to remove as much as possible what's called the systematic risk or the market risk from the portfolio. So the idea is to just capture the return or the risk premium of the underlying assets and to combine those assets in a way to where the systematic risk of each one of them offsets. And so it's really about maximizing the diversification benefits of the stocks, bonds, commodities.
So, and everything you do at the firm is 100% systematic, correct? So you guys aren't behind the scenes really trying to pull strings or making market calls?
Right. So yeah, it's systematic because, really it's just a process. And even if you're another manager, let's say you're managing a value strategy, if you have a process whereby you screen stocks for a certain metric and you have a rebalancing time frame, and you can eventually just get it to a process. And so we think that's important because if you have an idea about how something might work and you want to try it out, well, then you might want to put that into a system and run it through different scenarios to see how that might play out. So yeah, we are big proponents of a systematic process, whether that's actually including technical data and market data or however it's structured. But yeah, we think a defined process is very beneficial.
So are you continually working on and enhancing your systems, or is this something that you've built to be robust and doesn't really need to change over time?
Yeah, it's built to be robust, and so we don't imagine it changing at all going forward. We of course have the discretion to update it, but the system that we have put in place now is something I've been developing for a little bit more than 10 years now. And so in the beginning, it started off with an Excel spreadsheet and kind of 3 set portfolios that we would rotate in between, and that advanced, so on and so forth until the point where we are now, where any changes we make are really on the margin. They're not really, the underlying asset classes that we trade or the way we think about markets or the way we determine the position sizes. All those things have really been sorted out through the time. And so any changes we would make, I think, are going to be pretty marginal.
So you started building this 10 years ago. Along the way, I mean, you started in Excel. Did you have to learn how to code? I mean, are you self-taught in that area as well to build this thing out?
I wish I could tell you I knew how to code, but I don't. So at my previous firm, there was someone who worked there that had coding experience. We also used a portfolio management software where people at that software company knew how to code and build strategies, and so we hired them to develop some of the initial ones. And then PMV, our Chief Operating Officer, Mark DiGianantonio, knows how to code, and so he's built the current iteration. And but yeah, no, I kind of just direct the process.
I was the same. I mean, I've been doing this for probably 10 years as well in the systematic space. Exactly 10 years. So it'd be 2013. And
Yep.
I start looking into the back end of the code, and I'm so afraid to touch anything because if I could break the whole thing really quickly. And so I have to rely on others for that. But you learn a lot. I never thought I'd be in the space where I was having to at least familiarize myself with it.
Yeah, that's it. Definitely.
So tell me about the strategy behind ARP, right? We know it's risk parity, but let's really dive deep into what you're trying to accomplish, how, the composition of the portfolio tends to look and can change. So, let's really dive into what investors are going to see when they invest in ARP.
Yeah, great. So I think what's exciting about the strategy is that it's really integrated the macroeconomic environment and outlook with the systematic process. And so what I mean by that is when I said risk parity is trying to minimize the effects of the market cycle on the portfolio, I think we need to start there and kind of talk about and define what I mean by systematic risk and what goes into that. Because once you get to the asset class level, there's not individual stock risk, right? So the risk that is inherent in the overall stock market, for example, is the risks that are driven by the underlying economy. And the cycles that we're experiencing, and we're going through a very interesting one right now, which we can talk about if you like, but what we're going through right now in the economy is the same trade-off that we always get, which is this trade-off between economic growth on the one hand and inflation on the other. So if you don't think about investing at all, you just think about the economy and the market cycles, what's driving those cycles through time is economic growth and inflation. And that mechanism is really a debt cycle, because when inflation is low and economic growth is low, the Fed, the central bank, whatever country you're in, will step in to spur growth, and they can do that up until a point when inflation becomes a concern, right? And then obviously reverse course. So that trade-off is the trade-off of the market cycle, which then translates into the systematic risk that we see inherent in each asset class. So what's interesting too is that there's not a different market risk or systematic risk for stocks or bonds or commodities, because people often think, well, there's the risk of stocks, and then there's the risk of bonds, and then there's the risk of commodities, right? But in reality, it's one systematic risk. They're all driven by the same underlying economy. They are just influenced differently by those trade-offs. So if we start with stocks, for example, when do stocks go down? When do stocks hit a bad environment? And that's when economic growth is slowing or when inflation is high, right? But if you think about commodities, when do commodities, we're talking broad commodities here, tend to perform best? And that's when economic growth is high and inflation is high, right? So what risk parity is trying to do is to identify which broad asset gives the most direct exposure to the changes in those underlying variables that you can, such that you can mix them together in a way that offsets that systematic risk. And so if you think in your mind about a 4-quadrant where, and you're probably familiar with this, but
I was just going to bring it up because I was on your site, and you've made a very complicated idea very easy to understand. When you go on your website, you have it quadded, and then you show over time when we are in these different environments and what would be the best investment during that particular year and month.
Yep, exactly. And that research is really from Ray Dalio and Bridgewater, if you're familiar with them. And risk parity is really an offshoot of the all-weather strategy. So if you hear all-weather and risk parity, they're referencing the same thing. And so the macro research is really driven by them. And so on a static basis, the classic or static risk parity portfolio will try to balance the risk between the 4 environments that are created by increases and decreases in growth and inflation, right? Because this portfolio construction idea, so if you think about building a portfolio and you want to maximize diversification, which is the same as saying you want to minimize risk, right? Then the way you do that is by having positions that have different correlations. When one goes up, the other goes down, right? And you need to have the same risk allocated to each one, because take the 60-40 portfolio, if the stocks in that portfolio are 5 times or 4 times riskier than the bonds, then when you do the allocation on the risk, stocks are accounting for more than 90% of the risk of that 60-40 portfolio, right? So if you look at the correlation of a 60-40 portfolio to, let's say, the S&P 500 is around 0.95, which is telling you you're not getting any diversification benefits. So the risk parity concept is about balancing risk between uncorrelated positions.
Well, I think the average investor learned that last year, right?
Right.
You had both fixed income and equities. You got the full brunt of the downside and the lack of diversification benefits of that portfolio last year, right?
Yep, that's exactly right.
So what primary factors help drive better risk-adjusted return in your model, right? So and let me ask that a different way. I should say, in what environments you should always own risk parity, in my opinion, right? I think it always deserves a spot in your portfolio. But when are you going to produce the most alpha in this portfolio? Is that in recessionary environments or in market vol? And when I say market vol, equity vol?
Yeah. So to answer that question, I think it would be helpful to explain what we're doing as compared to a static or traditional risk parity, because we have an adaptive process whereby we identify the momentum trends that are created by these economic environments. So the name of our company, PMV, is the equation for momentum. And so what we're doing, our thesis essentially is that the broad momentum trends that you see, if you just pull up a graph of, let's say, commodities, right?
Mm-hmm.
The broad trends that you see in these underlying asset classes are created by the underlying economic environment. And so instead of passively allocating risk between the four scenarios, we identify where we are in the macro cycle from the relationships of the assets, and then we use that to determine our underlying allocation. So, if you take the past couple of years as a great example, obviously broad commodities were up a lot from 2020 through June of last year. And at the same time, treasuries, long duration treasuries, were down close to a similar amount. And so if you look at the spread, the difference of those, that's telling you you're in a high growth, high inflation environment. And that's been coming down. Those trends have been coming down to where right now we see the market pricing in slowing growth and slowing inflation, which, whether that persists or whether the market's correct, that's kind of what we're seeing is getting priced in. And so, when our strategy will perform best is when we are in an environment when those trends are persisting, right? And when more than one asset class is performing well. So if we're in an environment when the only, asset class that's going up is, let's say, commodities, then it's going to be hard for us to diversify because without giving up return, because any risk that we allocate to outside of that is going to be a drag on the performance, right? And risk parity portfolios, will tend to have a hard time in a rising rate environment, because if you think about any asset, whether it's stocks, bonds, commodities, you can determine the value of those assets by the present value of their future cash flows, right? So as you raise the interest rates or discount rates, that in theory brings down the value of all assets. And so in that environment, it's hard to find positively trending things and to diversify when, the correlations of a lot of those assets are coming together and the returns are going down together.
So when you're starting to build these portfolios out, and from a holdings and holding construction perspective, can you guys go anywhere? Or are you just buying broad equities, broad commodities, broad fixed income? I mean, can you kind of go anywhere, or is it just kind of broad ETFs?
Yeah, so our investment universe is set. We have 8 different asset classes that we trade, and I'll mention what those are, but I also want to mention that it's a fund-to-fund structure. So our ETF trades other ETFs. And the reason we set it up that way is that we could trade a futures contract on each one of the underlying indexes or assets that we trade, but then our investors would be subject to the 60/40 tax treatment of the futures contract. So by taking out a little bit extra expense from the underlying internal expenses of the Vanguard, iShares, other ETFs that we trade, we can, through the custom basket creation process, minimize to the extent possible the cap gains. So that's why we even though it's a little bit more expensive, chose that fund-to-fund structure. And then I mentioned the 4 different market environments. So when equities are performing well, we can go U.S., international, or EFA. So no sectors, no individual stocks, just broad assets, U.S., international, and EFA. And then, or emerging, sorry. And on the bond side, we have short duration T-bills and long-term 20-plus year treasuries. Because no other bond is a diversifier to stocks, right? If you go down the credit scale, you're just getting correlation to stocks, right? So we just want treasuries on the fixed income side. For commodities, we just trade the broad commodities basket, but then we also separate physical gold out separately, because in a stagflationary environment, which I anticipate us being in, then you don't want broad commodities. Broad commodities peaked last June, right, as economic growth started slowing, and you saw gold, rallying much more over this recent period. So those are the assets.
So are you using inside of the basket? Let's just stick with equities, right? So you have three different places to choose from inside that equity universe. You're then applying momentum calculations to figure out the weighting of those asset classes on top of the quad decision, if we can call it that.
Yeah, great question. So we have a monthly rebalance, and we start with a clean slate, right? So no set targets to any of the assets that I mentioned. Then what we do is we measure the momentum over various look back periods, because the momentum that I'm talking about is persistent, we think, somewhere between 3 months and 12 months. But if you just picked one window, then you're going to get a different response, or right. So we take multiple readings between a 3 to 12 month period, and then we essentially just develop risk parity portfolios over each of those periods and blend them together. So the first thing that you want to do is invest in assets going up. So the first thing we screen for over each of our windows are positively trending asset classes. Then what you want to do is, of those assets that are going up, of those positively trending assets, to the extent possible, you want to minimize the risk. And that's where you look at correlations and standard deviations and all that. And so within each of those periods of assets going up, you try to balance the risk the best you can.
So are there guardrails on weighting inside of a quad? So, could theoretically you invest just 100% US and not in international or emerging markets, or are there certain guardrails where you can go?
Yeah, great question. So there's a 40% max to each of those assets that I mentioned. So if US, international, and emerging were all positively trending over each of the look back windows, which I don't know that that's ever happened, you could in theory go 100% to equity, but it would not be all US. It would be some international or emerging. In reality, what you get is different readings. So for example, right now, our shorter term window is giving us a different signal than our longer term. The shorter term has been, kind of a loosening of conditions, more equity weighting. So we're getting a lot of equity allocation from our shorter term window. But as you go further back, we're still getting, some risk off trades, some US dollar currency and T-bills, physical gold, right? And so what you end up with is, when you're getting different signals, a very balanced or non-concentrated portfolio. But then when you get the same reading over all of those different windows, a pretty highly concentrated portfolio with still that 40% max to any asset or index.
That makes a ton of sense. And so when you built the index, I would assume is passive, correct?
Mm-hmm.
Yeah. And you said you rebalance on a monthly basis?
Monthly, right.
Okay. So let's pivot a little bit.
Sure.
That was a masterclass in explaining risk parity. I think people are going to learn a lot from, even though brief discussion. But let's talk about the business side, right? How long did it take you to get this ETF to market? You said it took you most of last year, but talk about that process of actually from decision to do it to first trade.
Yeah, so we decided to do it sometime in. Oh, my light just went off. We decided to do it sometime in April or May, and so from around April to the end of the year, that was the time frame. A good friend of mine went to SEI, and so we were in talks with some other providers and doing diligence on who we might partner with, but ended up going with SEI, and they were really integral in helping us find partners and going through the whole process. And my other partner, I mentioned Mark on the operations side, but my other partner is Andrew Nall, and he was an enforcement examiner at FINRA. And so he is very familiar with the regulatory environment. And when he's not familiar, he can read these regulations and integrate them way quicker than I'd be able to. So he helped us, navigate all of the legal and compliance side. But yeah, it was a learning process, because you can trade ETFs, but until you actually understand the underlying workings of the operations side and all that goes into it, it's pretty remarkable how efficient this trading system is and the structures that are there.
Yeah, it's definitely a learning curve, and you're extremely lucky to have a former SEC examiner. I think for us, the biggest thing that kept us up at night when we were deciding to launch this thing is to making sure we were doing everything correctly, right? We didn't want to accidentally get ourselves in trouble for something that we didn't know.
Right.
And so you don't have that worry. So that should that should allow you to sleep a little bit better at night. So
Yep.
as far as service providers, if you don't mind sharing,
Sure.
What service providers are you guys currently using? I know that was a long, dating process as we went through it. So
Right.
Who are you guys working with currently?
Yeah. So for our lead market maker, we went with GTS, and they've been fantastic so far. I think they're the largest on the New York Stock Exchange floor, if I'm not mistaken. And great team there, a lot of experience. So we've not had any real trouble on the liquidity side at all. And for our sub-advisor, we decided to go with a sub-advisor to help us trade, even though what we're not doing is really anything out of the box. But just to have that experienced team on our side was important for us. So we went with Vident.
Okay.
Yeah, a lot of advisors may not know that name, but they sub-advise on quite a few funds and ETFs. So good team there. And other than that, SEI does most of our other work, and then we listed on the New York Stock Exchange.
And so I'm curious, what drove that decision to launch on the New York Stock Exchange? We obviously all had other options to look at, but what made you guys decide to go with the NYSE?
Yeah, so I think the name brand was important for us. I mean, we're a relatively new company and fund, and so being able to launch on the New York Stock Exchange, I think, was pretty cool. But we also interviewed, as you mentioned, the other exchanges and got references and referrals, and it seems like the New York Stock Exchange and the NASDAQ are the two kind of primary players. And I think for what we're doing on the active ETF side, we see most of those style of funds also being listed on the NYSE. So, with the referrals and references we got, that was kind of the direction that we went down.
Yeah, they're very similar, thought process to ours. So being a relatively new fund, when you're thinking about distribution, right? Because at the end of the day, yes, we have to be really good at what we do on the investment side, but in order to stay alive, we got to think about distribution and marketing. So I would assume, I hate to assume, but I would assume you're marketing more towards investment advisors in that space rather than trying to go directly to retail, maybe just because of the complexity of the strategy.
Yeah, exactly. So we don't plan to go direct to retail, working with independent advisors and family offices. For the independent advisors, I'm very familiar with that space. As I mentioned, that's where I started out and working with them. And, what I was missing when I was building portfolios was the basic diversifiers, right? So, we mentioned before, most portfolios don't have any risk allocated to anything else besides stock. But the reason why advisors don't do that is because over the long term, stocks do have a higher risk premium or expected return than long duration treasuries or broad commodities or gold, right? So if you're going to sit down and build a portfolio with a client, even if you risk match those, over time, what advisors think is, well, we'll invest for the long term and not allocate risk anywhere else. So what we're saying is we can provide you the broad exposure that you need to these other diversifying assets in those environments when you might need them without you having to spend 10% of your portfolio on gold or 20% of your portfolio on long duration treasuries, right, to get that diversification. And the alternative discussion has been going on a lot in the independent advisor space, and some of these other products that are out there, you don't really understand the exposures that you get. If you think about some of the managed futures positions, they'll go long and short 40 to 60 different markets. There's leverage and shorting, right? And so they tend to be more complicated and kind of scare advisors when they go through periods that they don't understand the performance. And so what we try to do is provide a very clear understanding and story about why we're allocated to where we are. The advisors know exactly what the positions are. There's no leverage or shorting, right? And so it becomes a situation where they can build confidence and trust in the process by understanding what they're holding.
So how are you approaching, getting in front of advisors, right? What does marketing plan look like for you guys going forward? And what do you think's worked so far?
Yeah. So we have James on our team who joined us recently, and he's head of our distribution. And so we've just been networking with independent advisors. We've been hosting some events here in our office in Dallas. We've started a email outreach campaign. And honestly, LinkedIn has been great recently. I've been trying to post more and kind of bring awareness to some of these different issues on there, and been connecting with some advisors. So nothing out of the ordinary. It's really, emails, conferences, meetings, podcasts, LinkedIn,
Yeah.
that type of stuff.
Yeah, I was actually talking about this with a previous guest. One of the things that's odd in our business is, oftentimes you don't know who your customers are, right? You can do a 13F filing, but if they're not SEC registered, or a 13F search, but if
Right.
they're not SEC registered, you don't know who your customers are, and somebody could have just bought it, and you can't touch base with them and say how you doing, and
Yeah.
unless they reach out to you. But it's just it's definitely makes consistent marketing to those people a little bit more difficult.
Yeah, no, that's true. And, it's changed a lot in terms of, where you find advisors, but, we've tried some calling and that doesn't work at all. I mean, when people call me, I don't really pick up either. So, for some people that might work, but, we've kind of steered away from just cold calling people and trying to find more organic ways of connecting.
Yeah, that's great. So you answered this already, but maybe in a little bit more defined allocation style. If you're sitting down with an investment advisor and you're saying, please put ARP in your model portfolios, how would you suggest they build that asset allocation, or where does this fit inside of a kind of an overall portfolio?
Yeah, so we recommend that advisors leave their stock allocation where it is, right? Because for the advisors, you don't want to go through a prolonged period and have an client expecting to capture that upside, right? What we're saying really is that if you're spending 20 to 40 to even 80% of your client's portfolio on ag bond or core bond, that is not a good diversifier to the stock position, right? And so we tried to get them to think about replacing that ag bond exposure with what we're doing. Yeah. So, and we've run some numbers on it. So if you were to do that, even though our ETF is expected to have a higher standard deviation or risk profile than ag bond, because it's a better diversifier to the stock side, we don't expect it to add any additional risk to the portfolio through that replacement. But it does come in the form of higher return because, when we can, manage the risk better than, ag bond in some of these environments like we've seen, then that can not add risk overall while still improving the return profile.
Yeah, and I agree with that 100%. So hopefully investment advisors are listening, and especially the way that you've built the product, and in all honesty is, and you had alluded to this earlier, is you didn't make it extremely complicated for the underlying investor to understand what they're actually investing in. I mean, an advisor can't necessarily go at the level you're going to explain risk parity per se, but they can pull up your quads and say, in these environments, this is what we think is going to perform well. And in this quad, this is what we think is going to perform well. And they know what they're going to be invested in. And I think that that's very powerful for you guys and also for the advisor in kind of storytelling to the end client, what they're actually achieving here.
Yeah, that's actually maybe one of the biggest selling points that we try to touch on is that, advisors are looking for a way of communicating with their clients about where we are in the markets and how they are adjusting the portfolios to that environment, right? And so every month when we do the rebalance, we send out an update that says, based on the trends and the underlying assets, here's where we think we are in the economy, and here's how we've positioned the portfolios. And the advisors can use that information for the client. So, over the past year, if the communication to the clients were, in this high inflation environment, we're going to diversify your account with commodities, which are up 16% last year. But these trends are changing, and if we hit a recession, you don't necessarily have to worry because there's one of these assets that's likely to be performing well regardless of the environment. So, if we can tell clients we might hit a strong recession, but in that environment, if the Fed starts cutting rates, that's good for these long duration bonds, which were up 33% in '08, right? So there's opportunity somewhere depending on the environment, and you don't necessarily have to be concerned about which environment we head into as long as you have the flexibility to adapt to that and find opportunity.
Yeah, that's great, and a great story to tell. And so, a couple of last questions. Do you guys have any plans for future product, or are you going to stick with flagship ARP and run it that way? Or what do you got on the table, or what do you got in the bag, if anything?
Yeah, so kind of my vision is really to keep it simple and just stick with this one ETF product. We'd like to put all of our effort into that and make it as great as we can. At some point, if there's a lot of interest, then we might launch a more aggressive version of the strategy because the risk profile of the one we came out with is relatively low. But no, outside of that, we don't really plan to, any other future product launches.
So where can people learn more about you, the company, the fund? Where should they be looking?
Yeah, great. So our website is pmvcapital.com. And on the site, we have a strategy tab that goes more into depth about the underlying process. There's an article on kind of the theory behind it and just a general presentation. I mentioned that every month we send out an update about where we are and how we're allocated. So if you'd like to receive that, it's on the strategy tab. You can sign up for the newsletter. And then also on the site is a page for the ETF where you can find, fact sheets and returns and all that.
Okay, well, great. Daniel, thank you so much for spending some time with me today. I think not only was this informative about the fund, but it was also educational. So again, thanks for spending some time with me.
Appreciate it, Brad. Thank you.